Good morning, everybody. My name is Alex Panas with Synthesis Wealth Planning, and I want to talk to you about some year-end tax planning before the end of the year. Under the new tax law that was signed in July, there's going to be some limitations starting next year on how much you can deduct for your charitable contributions. There's going to be what they call a new hurdle rate, which means that you can only deduct charitable contributions that are in excess of 0.5% of your AGI. So what that means is if you make $200,000, you can only deduct charitable contributions over $1,000 worth. So what a lot of people are doing is lumping future charitable contributions into this year. You can do that by contributing to a donor advised fund. So we're helping a lot of clients set up a fund where you can make the charitable contribution this year that accounts for multiple years worth of charitable contributions, but you don't have to actually give it to those charities this year. You can dole it out over the course of the future years from that fund in your normal course of charitable giving. Also note that going forward, if you're going to be utilizing the standard deduction, which I'll mention in a second, that may change for a lot of you, but if you're going to continue using the standard deduction in future years, you will be able to get a $2,000 charitable contribution that will be allowed even if you're not itemizing. That's $2,000 for a joint married filing joint filer and $1,000 for a single filer. Now, as far as the itemized deductions go, as you know, under the 2017 tax law, starting in 2018, we've only been able to deduct $10,000 of our state and local taxes, property tax and state income tax. That $10,000 limit is actually going to go all the way up to $40,000. So where many of you were not itemizing in the last 7 years, you may be able to itemize this year and going forward. Again, depending on your income, that $40,000 state and local tax deduction may get phased out, but that phase out doesn't start until single or joint incomes hit $500,000 or more. Secondarily, there have been some changes to 529 college savings plan distributions. So a few years ago, the law was changed that would allow distributions from a 529 for qualified expenses for K through 12 up to $10,000. That's been changed. It's now increased to $20,000 and retroactive to January 1st of this year. So if you had expenses in excess of $10,000 for K through 12, you could actually take an additional distribution from your 529 to cover those additional expenses this year. Also, they are now allowing qualified distributions from a 529 for credentialing costs. Again, the devil's always in the details, but for example, if you wanted to get your CFP designation, you actually could take a distribution for the 529 to cover those costs. Number 3, Roth conversions became a little bit more complicated this year as to how they are calculated, because many seniors will be eligible for a senior exemption. It's actually an above the line deduction that you get if you're 65 or older, $6,000 per person, obviously $12,000 per couple. So if you're going to create additional income by doing a Roth conversion, you may put yourself in a situation where that $6,000 exemption gets phased out. And that phase out starts at a fairly low income level. It starts at $150,000 for a married filing joint and $75,000 for a single filer. So you've got to do a calculation to determine if the loss phase out still makes that Roth conversion worthwhile. Also, this year, starting this year, certain filers will be able to deduct auto loan interest up to certain limits, tips, overtime, and of course I mentioned that SALT limitation. So if you're subject to those and you're considering a Roth conversion, come and sit down with us and we'll talk about what impact that will have and whether or not you want to do a Roth conversion, or if so, how much. Number 4, and this is the case every year, right? If you have accounts that we're not managing for you, you may be able to do some tax loss harvesting. That's where you take an investment that currently has an unrealized loss you sell that investment, you can take the proceeds and simultaneously reinvest them in a different investment. Right? It can't be the same investment, otherwise they don't allow you to take that loss for tax purposes. Unfortunately, or fortunately, the market's done quite well the last 3 years. So you may not have a lot of opportunity to do tax loss harvesting, but it's always good practice to check on that before the end of the year. By the way, if you are able to do tax loss harvesting and you do reinvest those proceeds into another investment, after 30 days, you can buy back the original investment that you previously sold. Number 5, maximize your retirement plan contributions. This year you can contribute $23,500 if you're under 50 years old. If you're 50 years or older, you can actually contribute an additional $7,500 to your 401k, 403b, 457 plans, etc. So see how much you've contributed. Oftentimes people estimate their percentage that they want to withdraw from their 401k, from their paycheck to go into the 401k, but it may not get to exactly that maximum threshold by the end of the year. So double check, see if you're on track to get to the maximum. If for some reason you've got some additional savings and in January you didn't plan on being able to do the max, but now you can, you still have the time to do so before the end of the year. And number 6, and always good practice, to periodically review your estate documents and beneficiaries. Okay, keep in mind beneficiary designations on your retirement accounts, IRAs, insurance policies, etc. Trump the wills. So in other words, those assets do not pass via the terms of your will, they pass via that beneficiary designation. So if there's been any changes in circumstance, like a divorce or a marriage or children, grandchildren, and you think you may want to make some changes, review those documents and make those changes now while you're reviewing everything else. And of course, if you have any questions, you can always feel free to call us, email us, and we'd be very happy to help you. With that, I hope you all enjoy the holidays and look forward to seeing you soon.